In this episode, we'll go through the remaining swing trades from September and October, two of which paid off handsomely. In this episode, we'll go over the swing trade results and adhering technical analysis of the remaining half of the alphabet. The companies we'll run through are the following: Swedbank, Synact, Taurus, Workhorse, Zinzino and Zwipe. Although going short was the right thing to do, this trade still backfired on me. Luckily, the position only constituted 4% of my portfolio value. I took a short at a 2.8 leverage here at the diagonal resistance, which also neatly coincided with the horizontal resistance line at 150. My stop loss was set at any closing outside the descending channel or above the horizontal 150 level. Some may argue that the channel is not confirmed, but it is, for it's got 3 touches both on the upside as well as on the downside. This becomes even more evident if we look at it on the daily chart. A couple of weeks later, Swedbank closed both outside the channel as well as slightly above the 150 kroner resistance line, upon which I released my position. But the very week thereafter, the price dumped by minus 10%, after which it retraced back up again. Upon this new recovery, it went on to form a second alternative channel. One that says the April and May dumps were technical exhaustion breakouts. Overreactions if you want. This trade again goes on to show the deceitfulness of diagonal support and resistance line, as they can be redrawn at any given time. The problem is that you often notice that a new line is in play first after you've been confused out of your position. Again, there is nothing wrong with diagonal lines, that's not what I'm saying, but basing any trading decisions primarily on those rarely end well. I've learned this myself the expensive way, so if you're wise, you'll learn from my mistakes. Cause I've sure paid for the both of us. In this sense, diagonal lines should rather be a substitute to more reliable aids such as horizontal support and resistance lines, as those tend to stay fixed. For diagonal lines are like a spoon. You still need a bowl to eat your freaking soup. I then went on to enter another short at 149.60 and at a 5.2 leverage at this significant level of resistance. I won't go through it too intensely, as there is a separate TA on it in which I will disclose my deeper reasons in full. But to neatly summarize it, this is just as much a strong trade with a good risk to reward as it is a hedge. This is why I absolutely love this trade. The stop loss is set at any closing candle above 154, as that would constitute a new local high, which will likely also coincide with a new index all-time high. And here's the thing, I wouldn't mind if this trade were to get stopped out, as that would mean my long position would statistically have paid off much more. But in the end, it's a good trade and it's a good hedge, and that's all to it. So far, the latter trade has generated me some 5% profit, and the result shown in a second is both the closed trade and the trade in progress. As mentioned in detail in the quick Synact technical analysis episode, I did expect the price to make another test at 32 to 36 prior to being ready on the upside. As it didn't, but rather broke above the perceived flag range, I decided to take an initial half position, which I did at 41.20. And as the price broke up and tested a new all-time high at heavy trading volumes, I entered with the remaining half at 44.80 in this weird-looking continuation pattern. I don't know what it is, to be honest, whether it's a flag or a weird-looking triangle, but it doesn't really matter now, does it? The price then rallied and was rejected right at the 1.618 fib. This is as beautiful as technical analysis gets. For up on that rejection, it entered a consolidation from which it technically looks like it has more to give. The RSI is still at a prime, we have a solid ascending trend line, and the price has recently retested the previous high as support. What makes me extra bullish on this position, of which I still have all intact, is that the index still has another few percent to its all-time high, which gives this baby the leeway needed to test the critical targets at 58.50 and 62.80. Now, here's where things get truly interesting. If the price gets rejected at 58.50 at a 618 fib between the 1 and 2.618 fibs, it statistically means that was the local top for now. But if the price were to push above it and get rejected at the 62.80 level, that would mean it likely has more to give on the upside, and that any rejection there is more likely a simple correction, a power amassing move to go even higher. For as discussed several times already, the 1.618 fib is often a reversal high, but the 2.618 is not. For you will rarely come across equities in which the 2.618 fib acts as a pivotal high, as in where the price reverses longer term. No, that's for the 1.618 and the 618 between the 1 and 2.618 fibs. Of course there are exceptions, just like scientists finally found intelligent life on stock forums. Shut up! I'm joking. Might be. But we don't care much for exceptions, do we? For good trading is a numbers game, and in numbers and gaming theory we trust. So far, as long as the index doesn't enter a significant correction, and as long as Synact can remain above the horizontal support at 44.80, as well as the short-term trend, things remain strongly bullish. In that case, whatever we see now is a likely continuation pattern. If these supports don't hold up, chances are strongly in favor for the intermediate trend to be tested. And mind you, this is not unlikely, especially given the US election at hand. And to any hooligans with 7 mouths and no ears who kick and scream about the inherently strong fundamentals and how the stock price just must go up for this or that reason, to those of you, I'm sorry to say that you will be the dead meat once the next crash strikes. For as little as those people may believe it, every stock on the market is affected by the macro moves. For the market is a psychological representation of the herd, and no stock is exempt. But we'll discuss this incredibly interesting and relevant topic in a future episode. When an equity plummets at a seemingly free fall rate, it is typically followed by a bear rally. Those bear rallies tend to rise aggressively but are as dangerous as playing with fire. That's why such trades should be avoided unless you are a firefighter, or at least seasoned enough a trader to know how to exploit it. For if you don't know how to play them with a mathematical advantage, you'll quickly find yourself playing 5-9 offsuit on a dry board and out of position versus Phil Ivey himself. It will likely neither be a pleasant nor cheap experience. And as I'm the Phil Ivey of trading, here is what happened. As the price plunged by 50% in just 5 days, and as the price reached a significant support line, a remarkably solid one at that, at which the price tried to break below but found its way back again, I decided to take a highly speculative trade. One that I'd be ready to sell again, soon thereafter. As the price stabilized just above the support at 48, I bought a position at 48.75 for a total of 2% of my portfolio value, with the intention of releasing it all if there were to be any signs of the support breaking. Thus my stop loss in this case was at any new low from that very day candle, in this case any breakout below 46. The following morning the price opened at 57 and began its rise north. I followed the stock meticulously but noticed that the power rush to the upside quickly wore off. I'd expected a bump at least to the 382 fib, but as the price struggled to get near, it struck me that the stock was entirely out of power, so I sold it all once the day's green candle turned red. Although the sellers asked for 57, the gap to the buyers was quite large, thus affirming the lack of purchasing interest. I still managed to drop my entire position at an average of 56. Later that day, the price seemed to stabilize somewhat at around 50. I bought back the same 2% as I had sold, this time at 51. But again the price struggled, and as it seemed entirely out of energy and wits, I released it half an hour prior to day's closing at 53.80. The following 3 days the price dropped by another 32% at most. Both trades generated a good profit, taking into account that they both occurred within little more than 24 hours. I won't go too deep on this one as it's a pretty boring one, and since I'm generally not too acquainted with the overall moves of American stocks. I bought at 1722 right before its technical outbreak as it looked incredibly strong already. The trade made up for a total of 4% of my portfolio and my stop loss was set at any break below the triangle. But as the outbreak reversed back into this area again, I released it all at 1792, for I did not like that break back into the channel. The following day though, the stock proceeded its annoying journey toward what would have been an 82% profit at most. Well, what can you say? Shit happens. But I would have still made the same decision over again. I bought Zinzino for 6% of my portfolio at 36.60 as I had missed the previous day's breakout above this resistance line. The breakout occurred at strong trading volumes and the stock had also been cooking for a move up for quite some time. I then sold off 1/6 of my position, or some 17%, as the price retraced and the RSI closed on the upper bearish blue, but also to secure some profits. The price was still in a steadily ascending channel, so I didn't want to go too bonkers selling off too much. As the price proved to move steadily and as it took out a new top on October the 6th, I added on what I had sold and another tiny extra at 46.90. And despite looking technically alright, I finally decided to sell off 77% at 48.50 for a few reasons. First of all, the price had been rejected at its local 1.618 fib, and with a big nasty spike sticking up in the air like an explicit finger. This I did not like and I had considered selling at this point but didn't due to its strong trend. As the price action continued, this 2-day top turned into a tweezer which opened and closed at the previous pivot top and the 1.618 fib. And to those of you who don't know, tweezer tops are inherently bearish. Secondly, the price had moved a bit too steeply for my taste in the last couple of months. Now, don't get me wrong, I like it for it's made me some decent profits. I just don't think it's a sustainable momentum given the approaching index all-time high, the US presidential election and the overall market ambivalence. And as we can see, the primary trend began its bullish uprise during the COVID bottom in March. In mid-August, this trend was replaced by yet a steeper trend line, which in early October in turn was preceded by an even more aggressive looking one. Now, the steeper a trend line is, the more fragile and unsustainable it becomes. As the 1-hour chart broke below the last and steepest trend line and as the RSI on the 1 hour also began to indicate weakness and a trend reversal, however temporary, I decided to let my money rest. And speaking of the RSI, the daily RSI is strong. In fact, it's incredibly strong, but as technical analysis is based on putting different key components together, the daily RSI alone is not enough to run the show on its own. If we move on to look at the weekly RSI, it may look strong at first glance, but when we properly analyze it, we also notice that it has a massive RSI divergence. This on its own is a big bear hunting season that certainly can support a due correction. A temporary break, at least on the EMA 200 on the hourly and the second trend line on the daily, would be a necessary sign of health. However, and this is the important part, as strong as the overall trend is, it may not stop there. If the index were to correct, as talked about at length in this recent episode, then I expect Zinzino to retest its primary trend, which would be some 25 to 30% temporary loss of value. Despite the fact that a retest of the primary trend line is neither likely nor expected, Zinzino has just retested its all-time highs and gotten rejected. Just like we are about to experience on the index. Sticking with this position at this critical junction is just too much risk. I'd rather secure my position now and then hop on board again when the technicals look more decisive and when the index has surpassed its all-time high to give free rein to the buy trigger happy sheep prior to their slaughtering. This baby is always fun. Since early July, this Norwegian gem has on its own increased my portfolio value by 15%. And upon taking the trade, I shared it on Twitter too, so to anyone who piggybacked me on this one, congratulations. But again, not financial advice, for believe it or not, I have losing trades and make mistakes too. Now, during the second swing trade round of mine, I bought in at 14.30 for a grand 11% of my portfolio. This golden entry spot had caught my attention long before it even got there, for it was a technically clustered support point. For this trade was backed up by no less than 1. The primary or intermediate trend line. Time will soon tell which of the two it is. 2. A strong horizontal support line. And 3. The green Ichimoku Kumo support. And on top of that, it also spiked down at the 382 support, which coincided with the horizontal support level. And this was on the Swedish swipe stock, which is the one I trade because the fees are so much lower. Significantly lower in fact, as they don't come with the robbery-like exchange rates. And when looking at the Norwegian stock chart, this support zone confluence was even stronger. I then proceeded to add on 20% to my position at 20.45 as the price had taken out the previous all-time high and as the overall technical map didn't show any signs of exhaustion. But then we reached this high. Now, here's the thing. For looking at the Swedish swipe graph, it does resemble the technical behavior of Zinzino quite a lot. And as steady as the trend may seem right now, I did pick up on growing temporary weakness. For not only did the price get rejected at the 1.618 fib, it also has a long and strong trend line, straight as an arrow in fact, from which the price time and again has gotten a bit overexcited. And each time it has had its sharp little mini rallies, it has resorted back to the primary trend and found support on it every time. It has in fact tested this trend line with quite a remarkable regularity. This discovery of regularity in swipe I owe to Framgångsjakten, so thanks for acknowledging and sharing that. Now, historically throughout this strong uptrend, the price has retested the trend roughly once every 40 trading days, give or take of course. And if we were to apply the same pulse, we'd end up here at the horizontal support on the hourly and the Ichimoku on the daily. This trend line is living on borrowed time. A break below it does not necessarily mean it's bound for a reversal. Many people seem to believe so, but that's incorrect, for just as often a trendline break means sideways movements within a certain range prior to being ready for the next move up. Having said that, the more times a trend line or support or resistance line is tested, the more violent the move tends to be once it breaks. Might be something to keep in the back of your head. So despite the strong trend, the reason why I'm turning temporarily hesitant to swipe is because of the 1.618 fib rejection, the well extended and tested trend line, its 1000% move in 7 months, the abrupt move up with the support of this short-term trend line, the historically regular primary trend test being due, and the fact that, as discussed in full in this episode, that the index closing in on its all-time high together with a presidential election bode for volatility. Throw to the mix the fact that swipe indeed did break below its latter aggressive trend line and then retested it from below as resistance prior to getting rejected, and I feel comfortable in having sold off my position for now. For that's what I've done. I sold off in 3 increments with 1/3 in each. First at 1885 as the stock began to show signs of doubt as it broke below its previous all-time high, and as the price had sailed through the Ichimoku and the RSI had made a clear upper bearish blue touch and looked overall weak. Then at 23.85 upon the 1.618 fib rejection, and finally the remaining third at 21.35 for the reasons disclosed in full. But make no mistake, for I'll be back in swipe, and I'm already keeping an eye out for a technically good re-entry spot. For the previous mid to long-term targets still stand, and for more on those targets, please watch these episodes. That was all for now, thank you and goodbye.